Steve, so what is going on with the U.S. consumer?
You know, Sarah, I think the U.S. consumer is quite healthy. All of the numbers that I've seen would tell you that she came out of the holiday season shopping. The MasterCard spending pulse number said that the holiday season was up 4%, saw some of the best apparel numbers we've seen in years. And the forecast, for example, from the National Retail Federation are that we're going to see somewhere around 3.8 to 4.5% growth in 2019. So I would look at it and say we have a healthy consumer.
You have a healthy consumer, Steve. At least that seems to be the backdrop. But do you have an explanation then for the weak December government sales number? Did people get sort of spooked toward the end of the month with the government shutdown and the stock market decline? Or is there maybe just something about the data that doesn't seem right? You know,
you've seen a lot of skepticism today from a number of the analysts about the validity of the numbers. The government, and I wouldn't challenge the methodology of the government numbers, but you see a lot of revisions. You'll have revision 1, revision 2, revision 3. And let's see what happens, because I'm a little surprised. For example, Amazon reported 20% growth in the month of December. That's half the internet, and the Commerce Department number showed a negative internet sales. Doesn't make any sense to me. So I wouldn't be surprised the government shutdown might have had an effect on it. But I feel very comfortable with the MasterCard spending pulse numbers, which showed a 4% growth in the month of December. And that, to me, is hard. You know, it's driven by credit card data.
So, Steve, if we are seeing a healthy spending consumer, as you say, it's not boosting everyone. I mean, we've gotten some mixed holiday sales reports. So which retailers, if you're an investor, do you want to own? Who's getting the benefit of all that spending?
Well, you're absolutely right. They're winners and losers. And I think that the companies that have embraced omni-channel, their buy online, ship in store, that they really understand how to play that are doing well. And retailers that are providing value to the consumer, I think, are doing well, whether it's the off-price players, the TJ Maxx's, the Ross's, the Burlington's performing well. The Walmart, I think, doing terrifically well with its cultural change, their omni-channel efforts, how they've been growing their .com business. I think Target reported terrific top-line growth during the holiday season. So you're clearly a lot of the apparel players reporting, specialty apparel players doing very well. So I see a lot of growth in the consumer. Home Depot is a good example. Hardware, home goods doing very well. So that's another good example of positive growth.
The picture you're sort of painting there, Steve, is one of the giants being able to absorb a lot of this investment and being able to touch a lot of customers, but maybe at the expense of some of the smaller chains and those that depend on foot traffic. I mean, is there any way to handicap whether that process is ever going to get any relief in terms of the smaller players, or is it just this is the way it's going to be?
I think there are two pieces to the answer. The consumer actually loves niche, specialty, unique types of brands. So small is actually where the consumer wants to go. The reality is that there's a lot of investment required, whether it's digital, transportation, labor, that are going to eat into some of the margin structure. So the really good big players are doing well. It could be a Best Buy, it could be a Walmart, it could be a Target. But I think that there are a lot of smaller players. In fact, the internet-driven companies, the direct-to-consumer brands, are now opening up stores, and they're doing very well. I look at the Warby Parkers of the world and see how well they're driving growth. So small can be beautiful as well, but I do think that the really well-run omni-channel players do have a good advantage in this environment.
What about the luxury players?
Well, luxury is interesting. Luxury is very much tied to the stock market. When I was running Saks, we used to think about a 90% correlation between the stock market and luxury. You clearly saw a slowdown in luxury in the latter part of the year when the stock market had its major issues. The fourth quarter was probably flattish for the luxury players. As you've seen a rebound in the market, my sense is that you probably see a lull that you saw in the November, December, and starting to see it come back as the market has rebounded. So longer term, I feel good about luxury, but clearly it is a volatile play.
And I guess, nothing you're saying suggests that we're going to get relief anytime soon from just store closures. I mean, it seems like that process just continues for a while now. And I guess the question being, is that going to be kind of a vicious cycle where, more malls become impaired and things like that?
It's a story of growth and decline. So last year you had probably 8,000 plus store closures, but you had 6,000 or 7,000 store openings. So you have a lot of these growth brands that are opening up stores, and then you have the Sears of the world, Toys R Us, closing a lot of stores. The malls are also the haves and have-nots. You have the A malls that are actually performing pretty well. You have about 20% of the malls doing 70 to 80% of the business. Then you have these C and D malls that are probably going to be slowly going away because they've lost their reason for being, or they're going to be repurposed into other uses. So malls are very much a mixed bag, and they've got to find a way of driving traffic to the mall by providing better experiences, something unique. It's got to be a place where people want to gravitate. It can't just be a restaurant. It's got to be an experience that people are going to go to, and the A malls are starting to learn how to do it, but they've got a long way to go.